Banks are tightening their lending requirements, and as a result, it's getting harder and harder to get approved for things like auto loans, home mortgages, or any types of financing at all. And as a result, this credit crunch could send things like the automotive market into a spiral. And while I think that we are all crossing our fingers and hoping that this will cause car prices to go down, and this will ultimately be really good for the average consumer who's looking to buy a car at some point in the future, we also have to acknowledge the fact that these credit limitations are going to make it incredibly difficult for anybody who wants to make and finance a large purchase this year. You see, a credit crunch occurs when banks become concerned about over-leveraging themselves. Banks want to ensure that they have enough cash on hand to cover customer withdrawals and to stay liquid through any economic situation. And so, in an effort to do this, banks will become much more strict with who they loan money out to. And as a result, people who were approved for things like auto loans back between 2020 and 2022, back whenever credit was easy to come by, these same people may not qualify for these same loans any longer, thus decreasing demand, increasing supply, and causing car prices to go down. But this also means that if you are somebody who's looking to purchase a car in 2023 and 2024, you have to be more strategic than ever to ensure that you're making the right financial decision. And there are a lot of things that you must keep in mind and stay on top of. But before we dive into that, I would like to take a moment to thank the sponsor of this video, Smart Credit. When it comes to buying a car, credit can have a huge impact on your vehicle purchase. Let's say you want to buy a $25,000 vehicle. If you have a 660 credit score, your interest rate would be about 10.99%. And financed over 72 months, you'd pay a total of $34,251 over the course of that loan. Now, if you were to boost your credit score by just 60 points to a 720, your interest rate would now be about 5.89%, dropping your total amount to $29,738 and saving yourself over $4,500. So if you're looking to buy a car in the near future, start taking actions now to boost your credit score using Smart Credit. Smart Credit is a patented money and credit management solution that has helped users boost their credit score fast. Their Score Builder feature deals with your payment history, which is 35% of your credit score. Through here, you can communicate directly with your creditors and financial institutions to address errors, ID fraud, and more. You don't have to mail any letters or get on the phone with anyone, it's all done for you. Also, the Score Boost feature helps you with 30% of your credit grade, which is credit utilization. It shows you exactly how much you need to pay off and by which date in order to gain the most points the fastest. By the way, it is not your due date. But we all know that credit is much more than just your score. Your credit score is directly impacted by your spending and financial habits, which is why Smart Credit's Money Manager allows you to manage all your finances from one simple dashboard and all your banking in one place. Thank you, Smart Credit, for sponsoring this video, and if you want to give Smart Credit a try for 7 days for just $1, then check out the link in my description below. Now, back to the video. Now, we spend a lot of time on this channel talking about things like car prices, but in reality, car prices are just one aspect of the equation, and there are a lot of other factors that you must take into consideration if you're somebody that's buying a car. Because you must also pay attention to things like interest rates, loan terms, credit scores, your overall purchase price, as well as a slew of other factors that will ultimately dictate whether or not a car is actually a good deal. But let's first take a look at credit score and let's see how this ultimately impacts your car purchase. When it comes to credit score, a borrower will ultimately fall into one of a few categories. The exact name and credit score ranges for these categories will vary a bit depending on who you're talking to, but in general, they're deep subprime, subprime, near subprime, or sometimes referred to as non-prime, prime, and super prime. And the category that you fall into as a borrower is going to be incredibly important, and it's ultimately going to dictate what type of car you can afford, how much you're going to pay, as well as the interest rate that you're going to have on your loan. For example, according to Experian's most recent market trend report, the average deep subprime interest in Q4 of 2022 was 13.42% for new cars, while the average interest rate for super prime was only 4.75%. So for example, if you were somebody that was looking to buy a new car in Q4 of 2022 and you had an 800 credit score, that would be considered a super prime borrower. And as a result, you could expect to pay about a 4.75% interest rate. On the flip side, if you were somebody that, let's say, had a credit score of 500, that's considered deep subprime. And as a result, you could expect to pay a 13.42% interest rate. This means that, let's say these two types of borrowers are buying the exact same car and paying the exact same MSRP for that vehicle. Let's use the example of a $35,000 car where both buyers are putting down a $5,000 down payment and they're financing it for 72 months. Taking into account things like taxes and additional fees, a super prime borrower with a 4.75 interest rate will pay a total of $43,924.22 for that $35,000 vehicle throughout the lifetime of that loan. $4,536.72 of that will be paid to interest alone. So that is purely the cost that you're paying in order to borrow that money. On the flip side, if that same car is being purchased by a deep subprime borrower with an interest rate of 13.42%, that person is going to pay a total price of $53,227.84 for that $35,000 car over the course of the lifetime of the loan. $13,840.34 of that is going to go to interest alone. A deep subprime borrower is going to pay more than 3 times the amount of interest compared to a super prime borrower simply because of the fact that it is significantly more expensive to borrow money as a subprime borrower versus a prime one. And this example and these figures that I've given today are for new cars. For used cars, these interest rates are even higher. This is why interest rates and understanding the role that interest rates play in the car that you're going to purchase is so incredibly important, not only to your current financial situation, but also to your future one as well. And truthfully, this is why buying a car in the current market conditions can be downright dangerous. Because if you're somebody who's buying an already overinflated car, you pay an overinflated interest rate for borrowing the money for that car, you can ultimately end up spending tens of thousands of dollars extra for a car that's worth a fraction of that price. This is how people become deeply underwater on their car loans, and this is a mess that's incredibly difficult to get out of. This is where credit score and interest rate are heavily intertwined. Because while interest rates are absolutely impacted by what's going on at a national level with the economy, they are also heavily impacted by your personal financial habits as well. A high debt-to-income ratio, late payments, evictions or repossessions, delinquencies, these are all things that can have a heavy impact on your credit score and thus your ability to effectively borrow money. And whenever we begin to start talking about interest rates of 13%, buying a car and borrowing money at that rate simply never makes sense. And at that point, you're better off just simply buying a car in cash or holding off on the purchase altogether. But now let's talk about loan terms. According to the same Experian report I mentioned earlier, the average term of a loan in Q4 of 2022 was 73 months for deep subprime borrowers, and it was 63.8 months for super prime borrowers. This means that not only are poor credit borrowers paying more in interest on their auto loans, but they're also paying that interest rate for longer because their terms are longer. And as a result, the overall purchase price of the exact same vehicle is going to be significantly higher. But let's look at this in the same context of the numbers that I mentioned earlier. A $35,000 car with a $5,000 down payment. The average deep subprime borrower financing for about 73 months at a 13.42% interest rate will pay $14,052.22 in interest for that $35,000 car, bringing the total purchase price to $53,439.72. Now on to the super prime borrower. We'll round their term up to 64 months, and with a 4.75% interest rate, they'll pay about $4,019.79 in interest, with the total cost of the car being $43,406.79. Your interest rate dictates how much you're going to be spending for the borrowed money, but the term dictates for how long you're going to be spending that money for. And ultimately, the higher the interest, the longer the term means the more that you're going to be paying. These factors that I've discussed is ultimately what can turn a solid car purchase into an absolutely horrendous one. And it's how borrowers end up getting into these debt holes that they have an extremely hard time getting out of. But the real question is, how can you avoid these traps? And if you've already found yourself in one, how can you get out of it? Well, the first thing that you need to understand is credit score, and understanding exactly what goes into that, what causes it to go up and down, and how can you ultimately improve it and keep up with it. You can start with the basics. For example, a credit card. If you have a credit card, never carry a balance. Always pay the card in full at the end of the month and make sure that you never make a late payment. I love credit cards. I have about a dozen of them, and truthfully, I cannot even remember the last time that I used a debit card for any purchase. But the reality of the situation is credit cards can be extremely harmful, and you need to be honest with yourself in determining whether or not you are in fact a credit card person. If you are, great, you can use this to your advantage in growing your credit score. But if you're not, then you absolutely should not use use them, should not get them, and you should cut up the ones that you currently have, because credit cards and poor spending habits do not go together. But these philosophies don't just apply to credit cards. You should also make sure to be applying these same principles to your bills as well. Make sure that you're paying all of your bills on time, no late payments, and don't overextend yourself. Next is explore credit unions. Credit unions can be a great alternative to more traditional mainstream financing, and oftentimes they offer really competitive rates. While the average interest rate for used car loans across all borrowers is between 6 and 7% with traditional banks and lenders, a lot of credit unions are offering something closer to about 5%. In fact, the credit union that I recently joined is offering interest rates of 4.5% on used car loans, which is incredible given the current market conditions. And last but certainly not least, pay extra towards your loan each and every month. When you make your minimum monthly payment on any bill, a large portion of that payment is going to go towards interest, which means only a small portion is actually going to go towards paying that loan down. But when you make additional payments towards your car, in addition to your minimum monthly payment, you can actually opt in to have that payment go to principal only. So you're not going to be paying any of that towards interest, and it will just go down to decreasing the loan amount. This means that if you have a $30,000 car loan and you opt to pay $100 in addition to your minimum monthly payments per month, you can not only decrease your loan term by 14 months, but you'll ultimately save about $3,000 in interest payments. There is a really handy calculator you can use. I'll link this down in the description below so you can play around with it if you'd like. One thing I do want to caution you on is that if you do end up going this route and you want to make extra monthly payments, make sure and confirm with the bank that that payment is going to principal only. HP and I have been paying extra towards this GT500 for the last year, and I actually didn't find out until a couple of months ago that our extra monthly payment was not going to principal only, and it was also going to interest. As a result, only about 75% of that extra payment was going towards the principal. In the case of the GT500 loan, we actually had to physically opt in to applying the payment to principal only by checking a box, which was something that I had no idea until I made the payment on my desktop, which is actually super annoying and pretty scammy. Like, who's making an extra payment and doesn't want that extra payment to go to principal only? But that's neither here nor there, I guess. And another final note that I must mention is to use math in order to justify your decision. Now, I understand a car purchase is absolutely an emotional one. It can be something that can be very difficult to decide on, and once you know that you want to buy a car, it can be extremely exciting. But the reality is, whenever it comes to anything regarding your finances, you need to make sure that the math makes sense. Oftentimes, the math involved with financing can be justified by comparing your financing rate to how much that same money would make if you were to invest it. And the rule of thumb is typically in the 6% range. If your interest rate is 6% or below, financing a car can make more sense than paying cash. Because if you were to put that exact same money into the stock market, you would be able to make at least a 6% return on average on that money. Thus, you'd make more money by financing than paying cash. But once your interest rate increases past that 6% number, the math doesn't add up quite as well, and it starts to make more sense to simply pay for the car in cash or pay off the loan as quickly as possible. And once you get into the double-digit interest rates, it is very rarely, if ever, going to be something that makes financial sense. And in those cases, it makes sense to either simply pay off the car in cash and buy it outright, or to pay off the car as quickly as possible once you have the loan established. But once interest rates pass that 6%, it ends up making less sense. And once interest rates are in the double digits, then it makes virtually no sense. Paying $53,000 for a $35,000 car because of astronomical interest rates will never ever make financial sense. So if all else fails, or if you feel unsure about a vehicle purchase, make sure to sit down and do the math, because the math doesn't lie. And if the math doesn't make sense, then I would encourage you to either buy the car in cash or hold off on that purchase altogether, because interest rates will not stay this high forever and they will eventually come down. And in the meantime, you can take active steps in order to improve your credit so that you can get a better rate in the future. But with that being said, you guys, I hope that you enjoyed this video. If you have any questions, comments, if you have anything to add, I would love to hear it. So make sure to leave a comment down below. And while you guys are at it, make sure to hit the like button, hit that subscribe button, and hit the notification bell. And I will see you guys in the next video.